April 2025. In 48 hours, markets fell 9% on tariff announcements. Millions of investors were watching their portfolios turn red. Some checked their balances once, some checked them 20 times. Some sold, some held. By mid-May, markets had fully recovered to where they started. The investors who sold had locked in a real loss, then watched the recovery happen without them, then had to decide when to buy back in. By the time most of them felt safe enough to return, prices were higher than where they had sold. They did not lose once, they lost twice. First loss, selling during the fall locked in the paper loss as a permanent real loss. Second loss, missing the recovery that followed immediately after. Two separate financial decisions from one emotional moment. That is the mechanism this episode is about. And there is a number, published by institutional researchers since 2007, that changes how you think about this forever. Most investors have not heard it. In this episode, the psychology behind why the brain makes this decision. Why the same data that should make holding obvious makes selling feel urgent. The single rule that prevents the second loss. And the institutional statistic that has been sitting in plain sight for nearly 2 decades. Stay with us. I have made a number of good financial decisions this year. I also spent 40 minutes last Tuesday deciding whether to buy oat milk or regular milk. Bought both, put both back. Left. I then spent the commute home thinking about whether I had made the right choice. I know what you are thinking. I also cannot believe I am the one explaining long-term investment psychology. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. Quick note if you have been following this series. In episode 1, we looked at why the wealth-building window opens and closes and how most people miss it entirely. In episode 3, we looked at how 50 pounds a month compounds into something meaningful over decades. Both of those connect directly to today. Panic selling is the mechanism that closes the window and breaks the compounding simultaneously. If you are new here, welcome. This episode works on its own. Now let us get into it. If you find this useful, subscribe. New episodes every week. Nadia is a financial markets correspondent. For 11 years, she has tracked the gap between what institutional research shows and what reaches the public. Each year, she covers the DALBAR quantitative analysis of investor behavior. Most financial journalists do not. DALBAR has tracked actual investor returns since 1994, not theoretical returns. Not what the index returned, what real investors, with real accounts, real emotions, and real panic responses, actually earned. Over the 20-year period ending 2023, the average equity fund investor returned 6.81% per year. The MSCI World Index returned 10.15% over the same period, a gap of 3.34 percentage points per year. On a 100,000-pound portfolio held for 20 years, that gap is worth over 220,000 pounds in lost growth. DALBAR attributes most of that gap to one behavior, not to fees, not to poor fund selection, to emotional selling decisions during market volatility. 220,000 pounds. That is the cost of emotional decisions across a working lifetime of investing. Not a fringe outcome, the average outcome for the average investor who responds emotionally to volatility. The dataset covers 20 years of real market behavior, including 2 major crashes. The gap exists because of what investors do when prices fall. Today we are going to explain what that is and why. In April 2005, markets fell 9% in 48 hours on tariff announcements. If you had 10,000 pounds invested in a global index fund on the morning of April 3rd, by April 8th you were looking at a balance of 9,000 pounds. On paper, the word on paper matters. The money had not gone anywhere. The companies in your index fund were still operating, still generating revenue, still compounding. The market's estimate of their value had temporarily changed. Nothing else had. Here is the mechanism. When you sell during a fall, you make 2 decisions simultaneously, even if you only feel like you are making one. Decision 1. You convert a paper loss into a real loss. The balance was red on screen. You made it permanent by selling. Decision 2. You create a timing problem with no clean solution. You now need to decide when to re-enter the market, and you will not feel ready until you feel safe. The market will not wait for you to feel safe. Right, so, wait. You lose on the way out because you sell at a lower price than you bought. And then you lose again because you buy back in at a higher price than where you sold. Both of those cost you money. From one decision, I checked my VWRL balance 7 times on the morning of April 8th. 7. I nearly sold. I had no plan for what I was going to do with the money. I just wanted to make the numbers stop being red. The conventional assumption in mainstream financial commentary is this: when markets fall, selling reduces your risk. You exit with your remaining capital. You wait for conditions to stabilize. Then you re-enter at a lower price than where you sold, capturing a recovery gain. This is the logic behind getting out before it gets worse. It is the most widely repeated piece of financial instinct in market downturns. Wait, so that means, even if I sell at exactly the right moment, which I cannot predict, I still have to time the re-entry correctly as well. I have to be right twice, on the way out and on the way back in. And I have to do both of those things while I am scared. Precisely, the DALBAR data shows the average investor who sold during a correction bought back in 77 days later on average. In those 77 days, markets recovered an average of 21%. They paid the full loss on the way out, then paid a 21% recovery premium to get back in. The timing assumption, that you can exit and re-enter profitably, does not survive contact with how real investors actually behave under fear. The reason this happens is not a failure of intelligence, it is the architecture of how the brain evaluates risk. Kahneman and Tversky documented this in 1979. Losses are experienced by the brain as approximately twice as painful as equivalent gains are pleasurable. A 9% fall feels like losing far more than a 9% gain feels like winning. This is not a personality flaw. It is how every human brain responds to potential loss. The market does not care about that architecture. It just moves. Marcus spent 30 years as a senior director of institutional investments inside bank boardrooms. He was present for decisions that have since become documented market history. He knows not only what those decisions were, but what was said in the room, what the internal models showed versus what humans actually did, and why the official account of events is not always the complete account. I am not in a position to speak to current institutional behavior. What I can tell you is what I observed in March 2020 when conditions were comparable. In March 2020, the S&P 500 fell 34% in 23 trading days. I watched experienced institutional fund managers, people who have done this for 3 decades, reach for the sell button. Some of them executed it. The ones who sold in March 2020, they missed the fastest recovery in market history. By August 2020, 5 months later, markets had fully recovered and continued higher. The 30-year rule is this: in every instance of panic selling I observed across 3 decades in institutional finance, the market recovered. The investors who sold did not recover with it. So here is what actually happened with me in April. I had checked my balance 7 times by 10 in the morning. I had the sell button open. I was trying to calculate whether the 400-pound paper loss was going to become a 600-pound loss. I had no idea. I was making up numbers based on nothing. Then I rang Maya. Maya built her first million at 38 through 9 years of index investing. She lost it at 40 following a financial advisor into a concentrated position. She rebuilt it at 44 by returning to the original method. She has one rule for market volatility. Kai. Close the app. Right now. Not in a minute. Close it, set a reminder for 6 months. Come back then. If the world has not ended, your portfolio will have recovered. If the world has ended, your portfolio is not your biggest problem. Here's the instruction in 3 sentences. Close the app during volatility. You cannot make a better decision with information that changes by the hour. Set the direct debit. Check in 6 months. Do it once. Make it automatic. Then leave it to run. Right. Quick one. 30 seconds. Stay with us. JP Morgan Guide to the Markets 2024. If you had missed only the 10 best trading days of the last 20 years, just 10 days out of over 5,000, your total returns would have been reduced by 54%. And here's the part that changes everything. 7 of those 10 best days occurred within 15 days of the 10 worst days. The best days and the worst days happen together. If you sell during the worst days, you miss the best days. This data has been published since 2007. It has not regularly appeared in mainstream financial advice. 5 facts, no hesitation. Fact 1. The MSCI World Index has returned a positive result in 78% of calendar years since 1970, over any rolling 20-year period in the same dataset. Positive in 100% of cases. 0 exceptions. Source: MSCI World Net Return Index 2024. Fact 2. The average market crash, defined as a peak-to-trough decline of 20% or more, has lasted 9.6 months historically. The average recovery from that low has lasted 2.5 years and produced total returns of 114%. The crash is shorter than the recovery. Source: Med Davis Research 2023. Fact 3. In 2009, the calendar year immediately following the financial crisis, the S&P 500 returned 26.46%. Investors who had sold in 2008 and not yet re-entered missed the full recovery year. Most had not re-entered by 2009. Source: Bloomberg Financial Data. Fact 4. Since 1980, the U.S. market has experienced an average intra-year decline of 14.2%. The average annual return over the same period, 11.5%. The annual declines are normal. The annual returns follow. Investors who react to the 14% as a signal to exit routinely miss the 11.5%. Source: JP Morgan Asset Management 2024. Fact 5. A £10,000 investment in the MSCI World in January 2000, bought through two major crashes, was worth approximately $51,000 by 2024. The same amount invested, sold during the 2003 crash and the 2009 crash, and reinvested at recovery prices each time. Approximately £31,000. The cost of two panic decisions across 24 years. Approximately £20,000. One detail from the Federal Reserve Fed's Working Paper 2022. Researchers tracked investor behavior during corrections lasting more than 90 days. Investors who waited for market stabilization before re-entering, defined as 2 consecutive weeks of positive returns, found that the market had risen an average of 7.3% in the 288 9 days they spent waiting for that signal. The waiting period was itself the cost. This does not mean holding any investment regardless of what the underlying asset is doing. A global index fund tracking thousands of companies does not go to zero. A concentrated position in a single company can. The reason to hold an index is that the asset is structurally sound, not simply because holding feels better than selling. 3 episodes, 1 argument. In Episode 1, the wealth building window opens through consistent investing. In Episode 3, compound growth does the work over time. In Episode 4, panic selling is the mechanism that destroys both. These are not separate ideas. They connect. The panel episode takes this further. 4 investors, 1 crashing market, 3 completely different responses. One of those responses was Marcus selling into the 2009 crisis. One was Maya holding through it. One was a third perspective you have not heard yet. It is in the description. The investor who held through every crash in the last 30 years is not a genius. They are just someone who closed the app. Subscribe, new episodes every week. In Episode 5, Diversification. Why spreading your money the way most people do it is not the strategy it appears to be. Full disclosure on the April situation. Maya told me to close the app. I closed it. Then I opened it again to check whether it had gone down more. Then I rang her a second time. She did not answer. I have since come to understand that this was not a coincidence. The app, incidentally, is still on my phone. I have hidden it in a folder called Recipes. I have not made a single recipe. Next episode is up there. Subscribe is over there. Both are better than whatever you were about to do instead. I know this because I have watched the next episode. I understand all of it. I have done approximately none of it yet. That is what the subscribe button is for.